Preparing for a banking interviews at National Bank of Bahrain interview? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer, followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about yourself and why you want to work at National Bank of Bahrain. I would position my background around finance, client service, and disciplined execution. What attracts me to National Bank of Bahrain is its strong local franchise, long history, and role in supporting individuals, corporates, and Bahrain's economic development. I want a role where I can combine analytical thinking with customer impact. My focus would be to learn the bank's products quickly, follow controls carefully, and contribute to reliable service and relationship growth. While answering, focus on your finance background, customer or analytical skills, understanding of NBB as a leading Bahraini bank, and why your goals align with banking, service quality, and national market development. Question 2. What do you know about National Bank of Bahrain and its position in the market? National Bank of Bahrain is one of Bahrain's most established local banks, with a strong brand across retail, corporate, treasury, and digital banking. Its advantage is not only size, but trust, local knowledge, and long-standing customer relationships. In a competitive market, NBB has been investing in digital channels while maintaining branch and relationship strength. I see it as a bank balancing modernization with stability, which is critical in a regulated financial market. Make sure to cover NBB's Bahraini roots, broad retail and corporate banking presence, regional relevance, digital transformation focus, and importance of regulatory trust under the Central Bank of Bahrain framework. Question 3. How would you assess the creditworthiness of a corporate borrower? I start with repayment capacity, not collateral. For a corporate borrower, I would review revenue stability, EBITDA, operating cash flow, leverage, interest coverage, working capital cycle, and historical account behavior. Then I would assess the industry, customer concentration, management quality, and security offered. Collateral is a secondary comfort. The primary source should be sustainable cash flow. I would also ensure the proposal fits policy, risk appetite, and regulatory standards before recommending approval. In your answer, talk about financial statements, cash flow quality, leverage, collateral, industry risk, repayment source, management credibility, account conduct, and alignment with internal credit policy and CBB expectations. Question 4. Can you explain International Financial Reporting Standards 9, expected credit loss, in simple terms? International Financial Reporting Standards 9 requires banks to estimate credit losses earlier instead of waiting for a loan to default. In Stage 1, a performing loan gets a 12-month expected credit loss. If credit risk increases significantly, it moves to Stage 2 with lifetime expected loss. Stage 3 is credit impaired. The estimate uses probability of default, loss given default, and exposure at default. The goal is more timely, forward-looking provisioning and stronger balance sheet transparency. Be sure to mention forward-looking provisioning, Stage 1, Stage 2, Stage 3, probability of default, loss given default, exposure at default, and why banks recognize losses before actual default. Question 5. How would you handle an angry customer at a branch or contact center? I would first let the customer explain the issue without interrupting, because many complaints escalate when people feel ignored. Then I would confirm the facts, check the account or transaction details within my authority, and explain what can be done clearly. If the issue needs another team, I would escalate with ownership, rather than passing the customer around. My goal would be to solve the problem, protect bank policy, and leave the customer feeling respected. While answering, focus on listening first, staying calm, verifying facts, following bank policy, protecting confidentiality, offering practical solutions, escalating when necessary, and turning service recovery into customer trust. Question 6. What are the main differences between a current account, savings account, and fixed deposit? A current account is mainly for frequent transactions, especially businesses, and usually offers high liquidity with low or no return. A savings account is for individuals who want liquidity plus some return on balances. A fixed deposit locks funds for a set period and typically pays a higher rate because the bank has more stable funding. From the bank's perspective, deposits are important because they fund lending and support liquidity management. Make sure to cover product purpose, liquidity, transaction frequency, interest or profit return, customer segments, maturity restrictions, and how banks use deposits as a stable funding source. Question 7. What AML and KYC red flags would you watch for in a banking role? AML starts with knowing who the customer is and whether their activity makes sense. Red flags include unclear source of funds, sudden large cash deposits, transactions inconsistent with the customer's profile, complex ownership structures, sanctions matches, or reluctance to provide documents. For corporate customers, beneficial ownership is especially important. I would not investigate beyond my role. I would document facts and escalate promptly to compliance through the bank's approved process. In your answer, talk about customer identification, source of funds, unusual transaction patterns, cash intensity, sanctions screening, politically exposed persons, beneficial ownership, and timely escalation to compliance. Question 8. How do rising interest rates affect a commercial bank like NBB? Rising rates can help a bank if loan yields reprice faster than deposit costs, improving net interest margin. But the benefit is not automatic. Customers may demand higher deposit rates, borrowers may face higher debt service, and credit risk can increase. Higher rates can also reduce the market value of fixed-rate securities. So the bank must manage repricing gaps, liquidity, customer retention, and credit quality together through strong asset-liability management. Be sure to mention net interest margin, loan repricing, deposit cost pressure, borrower affordability, credit risk, bond portfolio valuation, customer behavior, and asset liability management. Question 9. What is capital adequacy, and why is it important for a bank? Capital adequacy measures whether a bank has enough capital to absorb losses relative to the risks it takes. Under Basel-style regulation, assets are risk-weighted, and the bank must hold sufficient capital, especially high-quality common equity. For NBB, strong capital supports depositor confidence, regulatory compliance, and the ability to lend through economic cycles. It is not just a ratio. It is a safety buffer that protects customers, shareholders, and the wider financial system. While answering, focus on Basel principles, CBB supervision, common equity tier 1, risk-weighted assets, loss absorption, depositor confidence, lending capacity, and why strong capital protects the banking system. Question 10. If a relationship manager asks you to push through a weak loan proposal, what would you do? I would not approve or support a weak proposal just because there is business pressure. I would review the facts objectively, identify the credit gaps, and ask for additional information or mitigants if the deal can be improved. If the risk remains outside policy, I would state that clearly and escalate through the proper credit process. A bank needs growth, but sustainable growth depends on disciplined underwriting and independent risk judgment. Make sure to cover professional skepticism, credit policy, documentation, independent risk judgment, escalation channels, balancing business growth with control, and protecting the bank from avoidable losses. Question 11. Which financial ratios would you review before recommending a business loan? I would focus on ratios that explain cash generation and repayment capacity. Debt service coverage ratio is key because it shows whether operating cash flow can meet principal and interest. I would also review current ratio, gross and net margins, leverage, interest coverage, receivable days, inventory days, and payable days. Ratios should not be viewed in isolation. Trends, industry norms, and management explanations matter. The final question is whether cash flow supports the requested facility. In your answer, talk about liquidity ratios, leverage, debt service coverage, profitability margins, cash conversion cycle, interest coverage, trend analysis, peer comparison, and linking ratios to repayment ability. Question 12. How would you encourage customers to use digital banking while managing operational risk? I would explain digital banking through customer benefits, faster transfers, easier bill payments, account visibility, and fewer branch visits. At the same time, adoption must be safe. I would guide customers on secure passwords, OTP protection, phishing risks, and using official bank channels only. For elderly or less technical customers, I would be patient and practical. Digital growth is valuable when it improves service without increasing fraud, complaints, or customer confusion. Be sure to mention customer education, convenience, secure onboarding, fraud awareness, strong authentication, transaction monitoring, data privacy, support channels, and not forcing unsuitable customers into digital-only behavior. Question 13. What is a non-performing loan, and how does it affect a bank? A non-performing loan is a loan where the borrower is no longer meeting repayment obligations, commonly after a defined overdue period such as 90 days. It affects the bank through higher provisions, lower profitability, possible capital pressure, and management time spent on recovery. Interest recognition may also be affected. The best approach is early detection through arrears trends, covenant breaches, account deterioration, and borrower communication before the exposure becomes harder to recover. While answering, focus on missed payments, impaired credit quality, provisioning, income recognition, capital impact, collection strategy, collateral recovery, and why early warning monitoring matters. Question 14. How would you explain liquidity risk in banking? Liquidity risk is the risk that a bank cannot meet obligations when due without unacceptable cost or disruption. Banks transform short-term deposits into longer-term loans, so timing mismatches are natural. The key is managing them through liquid assets, stable funding, cash flow projections, stress testing, and contingency plans. Liquidity is also about confidence. Even a solvent bank can face pressure if customers or markets doubt its ability to pay on time. Make sure to cover the mismatch between cash inflows and outflows, deposit withdrawals, loan commitments, high-quality liquid assets, stress testing, contingency funding, and reputational confidence. Question 15. Describe a time you worked under pressure and how you ensured accuracy. In a previous deadline-driven task, I had to prepare financial data quickly while other requests were coming in. I broke the work into priority items, confirmed the source data, and used a simple checklist to avoid missing key fields. Before submission, I reconciled totals and asked for a quick review where appropriate. Under pressure, I try not to rush blindly. In banking, speed matters, but accuracy and control matter more. In your answer, talk about a specific situation: deadlines, prioritization, controls, reconciliation, communication, review process, and how your behavior fits a regulated banking environment where errors have consequences. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.